For many, the wars and instability of the last couple of years have brought tragedy and loss. But for a select group of insiders, they might have been an opportunity to cash in. From billions of dollars in conveniently timed bets placed on the oil market immediately before the Iran war disrupted them, to an alleged case of a member of the US military betting on Maduro's removal immediately before he was removed by the US military, 2025 and 2026 have given us plenty of examples of people finding ways to place bets to profit from the war and instability around them. And as things like prediction markets have given people new ways to bet on everything from political speeches to frontline movements, the risk of insider trading and perverse incentives has come more and more into the spotlight, where people with access to power or privileged information might find themselves incentivized to make decisions not based on what's strategically sound or right, but what's profitable. And so today I want to talk about insider trading and what potentially happens when war becomes the topic of a wager. Before we get into the specific profiteering off war and crisis part though, I'm going to want to open with a bit of insider trading 101. Think what it is, some of the financial tools that might be used to do it, and why it's potentially really, really dangerous for your markets. Then we'll get into the especially toxic incentives if you start bringing war and crisis into the mix. Before crystallising it all by hopping over to Kiwiland and Emutopia for a quick hypothetical example to demonstrate how the modern tools allow opportunities for people at just about every level of power, from executive office down to grunt on the ground, to potentially cause immense damage for everyone else by choosing to prioritise their own payday. And then finally we'll close out by looking at some of the things that governments and societies can potentially do to fight against this kind of stuff and lower the risk that parts of the world will catch fire, just so insiders can hit their geopolitical multis. Before we talk about the power of information and events though, let me welcome back a sponsor that might help you keep track of them. So let me welcome back a long-term sponsor of the channel, Ground News. As you may have noticed, the first part of 2026 has been rather eventful, and that might make the ability to quickly scan headlines or get different views on an emerging story all the more valuable. If you look at this headline about the United States boarding and seizing a sanctioned tanker, for example, that's all the information you really get. But others can add critical context. This one notes it's the 6th Venezuelan-linked tanker seized by the United States, while this one notes that the tanker, the Veronica, was seized without incident. The tool being used to make that quick comparison is Ground News. It reportedly draws on thousands of news sources around the world to enable you to quickly scan headlines, click through the main article itself if you'd like to read it in full, while also potentially getting a little extra context behind that coverage. Here, for example, you can see factuality ratings based on the work of different news rating organisations, as well as one of my favourites, if you don't recognise the source, ownership information. Beyond that, Ground News also provides you with a range of features to enable you to customise or broaden your experience. You can hone in on particular topics of interest, or embrace something like the blind spot feed, which you can use to surface news items that are overwhelmingly being covered by sources you might not ordinarily consume. As I've said in the past, that doesn't necessarily mean they're good sources or not, but in an era of online echo chambers, I think it can sometimes be useful to get a sense of what other parts of the internet might be reading. And it's one of the reasons why I've been happy to have Ground News as this channel's longest running sponsors. And so if you are interested, the link in the description will give you access to a 40% discount on a Ground News Vantage plan, which is the one I use. And so with my thanks to them as always, let's get back to it. Now, given today's agenda, I have to add a hopefully obvious disclaimer up front. Just like the video on corruption, this video is meant to cover how some of this stuff works and why it's dangerous. It's not meant to be a how-to guide. Similarly, this is not financial advice. Please do not go out and engage in insider trading, and if you're looking to make financial decisions, probably start somewhere other than a YouTube PowerPoint. Okay, so now we're all very clear that none of us is going to go out and do insider trading. Let's talk about how people might do insider trading. At its most basic, insider trading is trading in things like shares or securities based on material, non-public information. That means the what is being traded could be any number of things. It could be shares, it could be a commodity like oil, or it could be a range of other things limited only to the financial creativity of the people involved. The crux is not the asset in question, it's the information. And the reason that matters is because it plays on some of the assumptions we generally make about the stock market and financial assets in general. 1. In an efficient market, you generally assume there's a correlation between risk and expected return. A topical example here might be shipping. Let's just say you operate oil tankers and you come to me as an insurance company. If you want war risk insurance, I'm going to charge a very different rate to a ship just shuffling back and forth between North America and Asia, as compared to one that's going into the business of running the Strait of Hormuz. As the risk of that valuable asset copping an anti-ship missile or drone goes up, so too does the rate of return I'm going to want to compensate for it. This is also the reason a bank might charge a lower interest rate on a loan secured against a house that they can take if you default, as opposed to one against an unsecured credit card, because they can't exactly repossess a holiday after you've taken it. The second general assumption is that in efficient markets, public information is already priced in. What that means is the price of something should reflect all the information that's currently in the public domain about it. Even if that was uniformly true though, and you could safely assume that markets were rational, press X to doubt on both of those assumptions, there is a massive difference between public information being priced in and all information being priced in. Markets aren't psychic, and there are some things that can catch them by surprise. What you're seeing on screen there is a drop-off in the Australian stock market during the pandemic, whereas if somehow the market knew that COVID was going to be coming, prices should have been lower leading up to the event, knowing a number of companies were about to get poleaxed. Now, of course, information on hard-to-predict events like natural disasters is one thing, but what about information that might exist, just held only by a relatively small group? A resource company that's announced it's found a massive amount of gold, for example, is going to be worth more, all else being equal, than one that's just looking for some. The value of a pharmaceutical company might swing wildly based on the results of a clinical trial. Here's the thing though, inherently, even in an era of rapid digital communications, there is going to be a gap between some people finding out about something like this and everyone finding out about it. People like lawyers working on major merger and acquisition proposals might know the details long before the public does. Hence the existence of cases like the one you can see on the right there. As you can probably gather from the headline indicating that people were charged for, in that case, allegedly misusing that kind of information for profit, in most places this kind of thing is very, very illegal. Just like some of the forms of corruption we've talked about in the past though, making something illegal doesn't mean it doesn't happen. And for our purposes, in a very general sense, there's really only two components of the insider trading blueprint. An insider or group just needs access to either actionable secret information or a way to create actionable information, more on that a bit later on, and then a will and method to convert that information into personal profit. Which means it's time to move to a quick overview of part 2 of the insider trading blueprint, some of the financial tools they might use, old and new. A tempting option might be to look at the share market for a couple of reasons. Globally, it's a very, very big pond with a lot of capital invested and a lot of money to be made. It's also full of companies that might have their value swing wildly based on specific international developments. A blockade in Hormuz might catapult the value of an energy producer in another country. A new tariff regime on imported goods in a major market might collapse the value of a car manufacturer. So, as a financial device, our insider might simply choose to purchase shares in something they know is going to spike, and then enjoy the price increase when it does. Hypothetically drop $1 million into a stock that then goes up 20% overnight on some news, for example, and as long as you can then close out that position, you've made a cool 200 grand in exchange for pretty much nothing other than clicking a few buttons and being willing to flagrantly misuse the information that news was going to be coming. Fine. But 20%, 30%, those are rookie numbers. So if someone wanted to pump those numbers up, they might instead look to a little thing called derivatives. It simply means something that derives its value from something else. Over the years, the markets have come out with an absolutely dizzying array of these things. But because our main goal here is to demonstrate how gains can be magnified and insider trading can become so dangerous, I'm going to focus on just some basic ones. Calls and puts, which are a specific type of derivative called an option, tied to some kind of underlying asset like a share. These involve paying an upfront fee in order to get the right to buy or sell a given asset for a specified price called the strike price within a specified time frame. If I get a 60-day call option on a share, for example, you're basically going to a trader and saying, hey, I'm going to pay you some cash now, and in exchange, you promise that if in the next 60 days I come knocking on your door, you'll sell me 500 units of share X for a given price, no matter what the current market price is. A put is the same basic concept, just for a share sale rather than a share purchase. I'm paying to guarantee the right to sell my shares for a given price up to a certain point in the future, no matter what the market price is at the time. Basically, having calls might make you a lot of money if a share goes up significantly, while the value of puts is going to increase as the share price goes down. There are various ways individuals or institutions might choose to use derivatives like options. They can, for example, be used in ways that help mitigate or hedge against risk. However, just like a bunch of derivatives, options can be used not just to reduce risk, but also for degenerate financial gambling, basically allowing people or entities to make massive bets on the direction that a stock or the market will go, in a way that can massively magnify the potential upside, but also create a crushing downside. You know, the basic building blocks of many a Wall Street bet storyline. Let's use a quick hypothetical with some clean numbers to demonstrate the concept. Let's just say there's a generic defense company whose shares are currently priced at $500, and as luck would have it, I have $500 in my pocket. Now, if I think the share's going to go up, I could either use that $500 to buy a share, Or I could look at the options market where someone's offering calls with a strike value of 525, so 5% up from the current price, for $10 a call. Look at the chart and you'll see a difference in the risk and payoff structure between the two approaches. In terms of profit or loss, the approach using a single share just tracks the change in the stock price. It goes up 5%, you gain 5%, it loses 10%, you're down 10%. If you hold the call option to expiry though, anything less than a 5% gain in the stock price completely wipes you out. 100% loss as the options expire worthless. If the stock gets significantly above that strike price though, the profits take off quickly. Because for the same $500 investment, you don't have one share gaining value, you have 50 options. Again, there's a billion different ways to potentially construct derivatives and also to use them as part of a financial strategy. But they can be used to magnify potential gain at the cost of taking on a lot more risk. But for potential insider traders who think they know what direction the market is going to go, rather than just suspecting it, risk arguably isn't going to work in the same way. Because what the market perceives to be risky based on what it knows, the corrupt party here might consider a sure bet based on what they know. Obviously without making any accusation of inappropriate behaviour by any party. That's purely hypothetically how you might get reports like the one you see on the right there. The setting is early 2025. The US stock market had taken some pretty heavy hits, as the United States had been announcing and moving towards implementing its new tariffs. On the 9th of April, however, President Trump announced a 90-day pause on many of those tariffs. And almost immediately after that announcement, the stock market ascended into orbit. But per that BBC article on the right there, about 18 minutes before the announcement, there was a surge in trading activity. Quote, some traders bet over $2 million on the stock market increasing that day, even though it had gone through 7 days in a row of losses. End quote. The article notes that the number of contracts being traded per minute jumped from hundreds earlier in the day to about 10,000 per minute just before the announcement, and suggested that aforementioned $2 million bet, quote, could have generated them a profit of almost $20 million, end quote. The market may not have been up 10x, but using tools like derivatives, traders who obviously just had a random feeling about a quarter of an hour before the announcement could potentially have placed some very large bets and seen the payoff from it. Similarly, the obviously equally psychic traders who placed large bets in the global oil market about 15 minutes before the White House announced a deferment of strikes against Iranian infrastructure could have realised gains in percentage terms far larger than the raw market swing. Now obviously, the ability to play the stock market based on insider information has been around as long as there's been a stock market. But especially if you're talking specifically about trades based on information on war and crisis, these days they're not the only game in town. They also rely on a potential insider having access to a specific kind of insider information. You need to know something that you think will reliably change the value of something you can potentially trade on. And frankly, a lot of insider information isn't going to translate into that category. I, for example, have a pretty good idea of when the next Purring gaming video is going to release, but unless someone is willing to bet against me on what the release date is going to be, it might be difficult for me to turn that insider information directly into profit. A lot of insider information out there is pretty banal and unimportant. It might not have anything to do with the broad globe-changing events that can move entire markets, and instead be honed down to something much more specific. If the stock market was the only option, that might not be the kind of fodder insider trading is made of. But this is 2026, and the internet has apparently found a way to democratise insider trading opportunities. Let's talk about prediction markets for a moment. There are various platforms out there that call themselves prediction markets, but the basics of the concept are this. You take specific events or questions like these ones. Will Donald Trump visit Iran this year, for example? Then you have shares, if you like, in the various outcomes. If that outcome happens, the holders of those shares win and get paid $1 per share, while those holding shares in all the incorrect outcomes get nothing. The way that's balanced is the price of the shares, so whatever the market considers to be more probable is going to be more expensive to buy in the first place. Now, as a side note, if this sounds at all to you like betting, with the share prices reflecting the odds, then that's very, very interesting. But some of these markets insist that this is obviously not gambling, it's in exchange for trading prediction contracts on future scenarios. Specific mechanics aside, there's a couple of reasons we might care about these things in military contexts. For one, they allow traders to zoom down from events that might move entire markets to very specific, discrete events. That idea in and of itself isn't entirely new. It's not unusual in many countries for the sports books, for example, to offer odds not just on one team or the other winning, but things like if a particular player will score or not. What these prediction markets can do, though, is dial up the zoom lens even more. And as a very general rule, the more specific the events can be, the more people your market is potentially turning into insiders. Take this for example, a market with roughly $9 million worth of volume betting whether or not announcers at the Pro Football Championships would use specific words. Now, I'm going to go out on a limb here and assume that a lot of the time, sports announcers aren't going to be the kind of people with access to information on where the global oil market is going to go, for example. But the existence of a market like this turns them into insiders, because hypothetically the announcers, or the friends and family of the announcers, could look at the existence of a market like this and say, "Hey Bob, how would you feel about making an absolute crap ton of money, and all you have to do is slip 2 words into your announcing tonight?" Or potentially even more deniably, just refrain from using certain words and back the no case. Basically, by diversifying the events that are market relevant, you might be diversifying the number of individuals with market relevant information. Judges might be insiders, announcers, celebrities, politicians, business leaders. Heck, according to this one, the person designing the cover art for a video game is now also apparently an insider. Even if you could argue that in some cases the relevant information is mostly harmless, we've already seen alleged cases where it pretty clearly isn't. Recently, for example, a US Special Forces soldier allegedly essentially placed thousands of dollars in bets that Maduro would be removed from power immediately before he was removed from power. Looking at cases like that then, there's a couple of reasons the modern rise of the prediction market might matter for our purposes. One, they might provide very big and accessible markets. Trading on just 2 of these platforms is already reportedly in the tens of billions of dollars per year, with one estimate suggesting that prediction markets are on their way to a $1 trillion volume by 2030. They might be accessible with something as simple as an internet browser or a phone. Some might integrate with cryptocurrency, raising questions of traceability and anonymity, and thus provide access to a potential insider trading tool to insiders who otherwise might not have had ready access to other ones. If in the past, for example, you might be able to profit from classified military information by selling it to a foreign intelligence agency, you'd have to take the risk of trying to contact them first. With the prediction market, though, you might just be able to trade based on that information. And if the markets get specific enough, all kind of insider information will potentially do. If you hypothetically know that a military operation is about to be carried out, and there happens to be an online marketplace where you can potentially profit based on that knowledge, then suddenly anyone in the military with access to that kind of operational insight becomes a potential insider. As you can imagine then, trading on prediction markets is the kind of thing that you might really not want people with access to lots and lots of information to be able to do. That's why potentially the United States Senate banned senators from being able to do so, eventually. And by eventually, I mean about a week ago. As for the House of Representatives, they haven't specifically done so yet. But let's zoom this into the question of war and incentives. You'll remember when I first talked about the danger of corruption in the military, incentives were at the heart of the problem. The general danger, if you allow corruption to fester, is that you might encourage people to make decisions that are bad for the nation and military readiness, but absolutely fantastic for their odds of ever being a yacht owner. If you open up opportunities for insider trading, those same incentive risks might apply. That's not to say, just as with corruption, that everyone involved will bite all the time, but just the existence of the incentive alone might raise all kinds of risks. To take just one example, there have been markets out there where people are predicting movements on the Ukrainian frontline. Hundreds of thousands of dollars might be poured into a market, for example, on whether Russia will capture a given village by a given date. Some of that trading might be done by people who have absolutely no idea what the actual reality on the front line is, or who are basing their information just on what is publicly available. But if you consider the possibility of people closer to these events potentially engaging with these markets, you can imagine how all kinds of perverse incentives might filter in. And compared to something more brazen, like directly stealing or embezzling funds, it might not be immediately clear from casual observation that the insiders are doing anything wrong. For example, you're now in the shoes of Colonel Kleptovsky, a Russian commander in control of a given sector, who's been handed instructions to try and take a given Ukrainian town. Now, if I'm the colonel, I obviously can't guarantee my ability to take the town by a given date. That relies a lot on the Ukrainian defenders. But what I can potentially do is guarantee that I don't take it. So if, for example, there's a market predicting Russia will take that position by the end of May, owing to the Ukrainian positions in the area looking a bit weak at the moment, maybe I'm incentivized to set up an anonymous account, pile in on the no position, and then just schedule the offensive that I promised the higher-ups for the 1st of June. Potentially great for my pocketbook, militarily defensible if my units needed more time to prepare, and if it does ultimately allow the Ukrainians extra breathing space to patch together the defences and beat off the attack when it's launched, well, I've still cashed in, and that kind of failure happens all the time. Things get potentially even more dangerous when you realise it's not just commanders that could potentially be engaging with these things. Are you concerned, for example, about the defenders of a position being able to bet on the fact the position will fall? Attacking troops betting that a position won't be taken and then just conveniently not taking it? or military operations being taken and lives potentially sacrificed, specifically in order to move markets. These kind of frontline prediction markets, for example, might resolve based on some agreed public indicator. Colonel Kleptovsky can't just send in an email saying that he pinky promises a position has been taken and then ask the marketplace to pay out his bets. Instead, there might be some other agreed metric, whether a particular open source mapping indicator shows a position is taken, for example. But on a battlefield like the Ukrainian one, where troops on both sides have an incentive to conceal themselves in basements or dugouts as much as possible to avoid the drones, how do you potentially provide clear evidence that a position has changed hands? There are plenty of ways to answer that question, but one of the things we've seen in Ukraine are so-called flag planting missions, where drones, or sometimes troops, are basically sent out into the open with the primary purpose of planting a flag so that videos and images can be taken. Now, a lot of the time, this very dangerous and often costly manoeuvre is going to be for propaganda or reporting purposes. You can use these images on the news to try and influence public opinion of how the war is going, or you can send them to higher-up commanders to illustrate quote-unquote progress. But it's also easy to imagine a scenario where a prediction market with a lot of volume behind it might provide an incentive for one of these operations to be launched or not. After all, if someone important potentially has hundreds of thousands of dollars on the line, surely that's the kind of noble cause worth sending a couple of troops into the open for. After all, while new troops might cost the Russian government a significant amount in signing bonuses, training, equipment, and lost economic productivity, they don't really directly cost the commanders much beyond the paperwork to request replacements. The contention obviously isn't that that kind of thing is happening all the time or anything, it's that that kind of incentive is potentially very dangerous. You may also see perverse incentives apply not just to military operations themselves, but also the reporting on them. We'll expand on this idea a bit more later, but suffice to say in one recent case, an openly published Ukraine war map was at the centre of the story. The claim is that a significant amount, we're talking north of $1 million US, had been staked on if and when the Russians would take a particular settlement. The declared metric for whether or not that happened was the ISW Map, namely whether it showed a particular landmark being under Russian control by a relevant time. Reportedly, at an important moment, the map was briefly edited, triggering the bets to pay out, after which, according to the article on the right there, the change was quickly reverted. The ISW later put out a statement, saying that it had come to their attention that a, quote, unauthorised and unapproved edit to the interactive map of Russia's invasion of Ukraine was made on the night of November 15th to 16 EST. The unauthorised edit was removed before the day's normal workflow began on November 16th and did not affect ISW mapping on that or any subsequent day. The edit did not form any part of the assessment of authorised map changes on that or any other day. We apologise to our readers and the users of our maps for the incident. End quote. Now in this case, I'm happy to leave speculation on the truth of how all this played out to the audience. The point, the risk from our perspective, is the incentive. Because now you can potentially create scenarios where those reporting on a war might have an incentive to twist the nature of that reporting, not just for old-fashioned reasons like propaganda or national loyalty, but also for personal profit. If there's a very general principle to apply here, it's that you might want people in a position of power, especially coercive power, like the military for example, to exercise that power responsibly and for the right purposes. But if and when you start introducing the siren song of a potential payday into the equation, you risk creating divided loyalties between the way power is meant to be used and the way power can be profitably used. And historically speaking, divided loyalties in armed forces have tended to be a bit of an eventful combination. Just as when we've talked about corruption in the past though, I think there's a difference between discussing these abstract concepts and actually walking through a concrete example. One that shows how individuals at every level of power, from the very top to the front line, can potentially be impacted by these perverse incentives and use different tools to try and put personal profit above strategic outcomes. And so welcome back to the long-term standoff between purely hypothetical nations Emutopia and Kiwiland. Here's the situation. Against a backdrop of long-running tensions, the Emus have been watching nervously as the Kiwis build up their conventional missile force. Given the risk an extensive Kiwi missile arsenal might pose to valuable targets in Emutopia itself, the Emu leadership is currently divided between two security strategies. The peace camp wants to take advantage of a recent, if subtle, improvement in relations between the two states to negotiate some sort of arms limitation treaty. The coercion camp, meanwhile, isn't in the mood for a compromise. They want to see additional pressure applied to the Kiwis to stop their missile build-up, and if all else fails, launch military action to make them stop. A cold strategic evaluation probably suggests negotiations are a better option, even if they involve some concessions, and so very tentative, indirect talks between the two powers start. The markets, and some relevant industries in particular, absolutely jump at the prospect of long-term Kiwi-Emu peace. which opens the first opportunity for a couple of people close to the centre of power to recognise a potentially enormous opportunity. If they walk away from, stall, or even cast doubt on negotiations at any point, they know the markets are going to recoil, and there's an opportunity to bet on that happening. So, under the justification of putting more pressure on the Kiwis, the EMU-topians complained loudly about unrealistic demands from Kiwi land, suspend the talks for a couple of days, the insiders cash in, and then to take advantage of some yo-yo trades, they say the talks are going to be back on again, and extend the invitation to the Kiwis to come back to the table. Maybe the Kiwis agree, but some momentum and trust is lost in the process. An opportunity for a potentially invaluable deal is lost, and voices grow louder in the EMU-topian capital for a military option instead. While that's happening, you also have backbench politicians who might not be entirely across the strategic planning and not really understand everything that's going on, but they are able to discern a general vibe from their more senior colleagues that there might be a confrontational crisis on the horizon. Even if they don't know exactly what that bad thing or confrontation might be or how it's going to go down, what they could do, and in this scenario actually do, is look to the market and basically place a generic bet that things are about to get bad. There are bearish investment products you can go into, for example, that gain value when the general market goes down. Of course, now having put some fat stacks down on the bet that everything is going to shit, the financial incentive for those involved would be to make sure it all goes to shit on schedule. Meaning when these entrepreneurial EMU politicians are briefed later on and asked for their opinion, they take the view that forceful measures should probably be taken, preferably before their options expire. That then passes the question to senior planners who have to come up with military options. What strategic logic says they should probably do is weigh up all of the potential targets, the potential ramifications, the risks, and come up with a suite of strike plans and proposals for the politicians to select from. At this level of control, our potential insiders no longer have the ability to determine whether or not a war happens or what sort of public announcements are made, only what a war, if it happens, potentially looks like. But even that position brings with it significant opportunities for the would-be entrepreneurial insider. For example, consider the question of the EMU-topian target list. The goal is to knock out the missile program, sure, but how? Do you attack just the launch sites, the storages, the factories? What about the rail links? Even if the goal is specific, that doesn't mean the method has to be. So let's just say two critical vulnerabilities are identified here. There's a large Kiwi facility on the southern island that produces a number of valuable specialised components and also handles final assembly of their missiles. And then on the northern island, a massive rocket fuel and motor facility that supplies not just the Kiwi program, but also the global market. Given the limited resources available to the EMU-topians, it would probably be safer to concentrate on just one. The relevant Kiwi targets are in very different locations, so going for both would mean either extending the operation or doubling the CAD-DAD effort. If push comes to shove, the cold advice might be to focus on just the assembly facilities. But a couple of the individuals involved look at the situation and realise their incentive is to pick both anyway. Sure, it's slightly riskier, but from a military perspective, it'd make it harder for the Kiwis to reconstitute their program. And from a personal perspective, flattening one of the largest rocket propellant producing facilities in the world is going to have an effect on the market, meaning someone could potentially pass word to a friend of a friend of a friend that now might be a great time to go long on some of the other global producers. And so while multiple options are handed up to the political leadership, it's the double strike option that comes recommended and which is ultimately selected. The high-level blueprint for what's meant to be a short, sharp, surgical 12-hour air campaign is now set and endorsed. Now that a broad decision has been made, it's time to get into detailed operational planning. And as you move further down the chain, you're starting to bring in a lot of people with access to perhaps fewer financial resources than those near the top, and perhaps nowhere near the same level of control or financial complexity. As the potential operation gets closer and closer, one enterprising EMU officer is handed a task. They're given a potential target, a Kiwi surface-to-air missile site, and also a potential date range. Now, let's assume for a moment that our EMU officer isn't exactly across the stock market, doesn't know much about derivatives, and certainly doesn't have much control over whether world-changing events happen or not. But they do have a phone and a piece of valuable information. They know EMUtopia is probably going to be bombing Kiwi land next week because they're going to be the one bombing them. So, where's the dangerous incentive? National interest says shut up and tell no one, and that's what they do. But the perverse incentive says there's an online prediction market where people are betting whether or not EMUtopia will attack the Kiwis by a given date. And so if our officer thinks they can get away with it, the incentive might be to create an account and just place a harmless bet or two that things will probably go kinetic in the next, week or so. If that sounds fanciful, remember that relatively recently an Israeli Air Force major and a civilian accomplice were arrested, allegedly for basically using classified information on when the Israelis would attack Iran to place bets on when the Israelis would attack Iran. As one article put it, quote, the pair allegedly made $162,663 after winning the bet, which they agreed to split evenly between themselves, end quote. Maybe the case was enough to give the emu officer in our hypothetical the inspiration for his particular move, although presumably on the assumption that they're not going to get caught. Plus, they might rationalise that this is a relatively harmless exercise. No information leaked, they might think, and thus no harm done. Basically, as you can see, as we're moving down the chain of power, the subject of the insider activity can get more and more specific. If at the top level we were betting on the entire market, then on specific industries, what the prediction markets potentially bring in is accessible betting on specific events. Unfortunately for the emus in our scenarios though, the Kiwis understand that. And so in amongst all their more conventional defensive preparations, they're also doing something very simple. They're watching the market. Then at about 10 PM emu time, 3 hours before the first strikes are meant to land, Kiwi intelligence notices something strange. Ever since the Kiwis saw things like bets being placed on Maduro's removal immediately before it happened, or bets being placed on US strikes on Iran hours before those happened, they've added monitoring of prediction markets and stocks into their early warning system. So when they see the money piling up on bets that they're going to be on the receiving end of bombs within the next 24 hours, it's enough to grab attention. Because while our individual emu officer placing his small bet on the side might have felt what he was doing was harmless, the problem is he wasn't the only one that felt that way. The spike in activity is cross-referenced with other intelligence indicators, and the Kiwis conclude that something might be up. And so, out of an abundance of caution, an air defence system the emus assume is going to be mostly off its guard actually ends up going onto high alert when the first emu aircraft are already taking off. And as the first emu strike packages approach, the Kiwi AWACS are already in the air, and interceptors ready to scramble. The result is what was expected to be a short, sharp and cheap strike by the emus turns into a much more costly affair. On the ground, there's time to move some sensitive materials and personnel into protective bunkers, and in the air, the emus fly into a lot more resistance than originally expected. Multiple aircraft on both sides are shot down. Many of the launched cruise missiles and munitions are downed on the way to the target, and some aren't launched in the first place. And the result is the emus do a lot less damage with their first wave than originally intended. They're also now forced to dedicate even more resources to recovering aircrew who have been shot down over Kiwi territory. Surveillance drones are launched to try and locate any survivors, while combat search and rescue teams are put on alert. On the other hand, all those bets the emus would attack the Kiwis are probably resolved by this point, and so a number of insiders might already be counting their payday. And yet, the story might still not be over. As the fighting played out, these kind of insider incentives could come to bear in all sorts of ways, especially when it comes to incentivising the flow or non-flow of information. We've already discussed how insider incentives might encourage individuals to release or somewhat share information they really shouldn't, so it can be traded on. But we've also seen cases where insiders try and suppress information in order to protect their positions. Back in March, when the Israelis and Iranians were exchanging air and missile strikes, for example, a journalist was reportedly threatened, reportedly in order to retract a report he'd put out on a comparatively minor missile strike near Jerusalem. Why? Because reportedly traders on Polymarket were set to lose $900,000 as a result of that strike being reported, and so apparently decided that if they couldn't change reality, they could at least change the reporting of it. According to the journalist, one message he received said that, quote, "After you make us lose $900,000, we will invest no less than that to finish you," end quote. While another said, quote, "You have 90 minutes left to update the lie. If you do this, you will solve the most serious problem you have caused yourself in life. If you decide not to correct it and leave the lie intact, you will discover enemies who will be willing to pay anything to make your life miserable," end quote. In a way, this is a kind of weird reversal of the usual insider formula. Normally, insiders would want to act on a privileged piece of information about reality, and then benefit when that reality becomes known to the market, causing the market to adjust. Here, the traders knew they were wrong, but had an interest in the information saying they're wrong, remaining privileged, and not making it out to the market, causing them to lose. All of this potentially matters if you care about reporting, especially on sensitive international events like war, being as accurate and complete as possible. Because if you start bringing these kind of elements into the mix, you might be multiplying the incentives to censor or suppress information, not so much to protect the national interest or the security of ongoing military operations, but instead, Damo's payday. In our hypothetical, for example, overconfident emu insiders who bet on a quick and easy operation might now be stuck, and so they might have an incentive to start moving to try and suppress any information that blows up their bets, even if that means delaying people back home figuring out that they might have just stuck their hand in a strategic bear trap, and instead rallying around the flag and supporting doubling down on failure. A number of strategic ideas are floated in Emutopia, some quite publicly, everything from introducing ground troops to seize a couple of small strategic Kiwi islands, or launching strikes against key nodes in the Kiwi economy. Kiwi ISR does its best to keep up with the pace of emu operations, but luckily for them, again and again, intelligence is able to provide at least some early warning. Because time and time again, before a new escalation threshold is crossed or a new target type hit, there is a significant spike in trading on the prediction market suggesting that's what's about to happen. It's not often that much warning, it's not perfectly reliable, and it does come with false positives. But on more than one occasion, it gives the Kiwi defenders just that little bit of additional notice and is enough to make a difference. Potentially even worse for the emus, before this conflict even began, the Kiwis were working on trying to figure out where their intelligence was coming from. When emu officers were engaging with those prediction markets, their greatest fear might have been discovery by their own government. But it's also possible in a scenario like this for a geopolitical opponent to figure out the identities first. At that point, what the intelligence agency has is just ready-made blackmail. Because now you've identified someone who's already proven they're willing to misuse classified information for personal gain, and something you can threaten them with, namely exposing their crimes, unless they agree to dig into their stock of classified information and prove to you there's more where that came from. In this scenario, the Kiwis are able to compromise a number of emu officers to help augment their intelligence advantage even more. Which lets us jump forward to day 4 of the emu's 12-hour operation. Combat operations are ongoing, and the airspace over Kiwi land remains contested. And our narrative spotlight settles on the operator of an emu reconnaissance drone. Our emu equivalent to Private Conscriptovich is the last person in the force to get access to privileged information. They have limited decision-making power and have never traded a stock. But even at this level of the organisational totem pole, insider trading incentives can present themselves. You see, our operator is still engaged in the search for some of those Emutopian aircrew that were shut down in the first hours of the operation. They're obviously still flying the mission because they've been ordered to, but it's been 2 days now since word spread through the rumour mill that someone heard from a mate of a mate at the relevant HQ that they've already been captured by the Kiwis, and the higher-ups are just suppressing the news for morale purposes. Our pilots determined that even though it's a wasted effort, that's not going to stop them doing their job. But they also know they have a family at home, a mortgage, a car payment. Maybe there's a kid at home and another on the way, and a couple of extra dollary dues wouldn't hurt. And so, just as some did after the shoot-down of a US F-15 Strike Eagle over Iranian airspace, our individual in question starts scanning the prediction markets. In the US shoot-down case, before the market was taken down, users for a period were able to predict the fate of the shot-down US aircrew. Would they potentially be rescued by a certain time, for example? In that case, the market was taken down before it resolved, but let's just assume for the sake of argument that our emu operator is able to find something similar. And since they're pretty confident thanks to the rumour mill that the aircrew have already been captured, they bet that no rescue will occur in the next 24 hours. They might rationalise that as a bit of a victimless exercise, until, a few hours later, they see something. Or at least, they might see something. A clue or indicator perhaps out of the corner of their eye that the aircrew are in the area. Now, you have a case of clashing incentives. Honour and discipline say call it out, follow that thread, and see if you're onto something. The personal incentive says if you do that, there's a chance you just blew up your family's finances. Under those conditions, would our operator in question do the right thing? I think in most cases, in a lot of militaries, they probably would. With history providing so many examples of troops being willing to take risks or bullets for each other, you have to imagine there'd be plenty willing to take a financial hit for the same reason. But the point is, that's not guaranteed, and the fact the incentive exists at all is incredibly dangerous. If you don't want people to misuse power and information, you probably shouldn't incentivise them to do it. And by allowing our operator in this case to draw such a direct link between what they think they know and what they can potentially profit from, the system in this scenario has done exactly that. So, if we total things up a couple of days in, the emus end up fighting a campaign they probably could have avoided using a plan that could have been better, against an opponent who probably knew they were coming, using personnel who might not have their head in the game. All the while, the emu public are shouting at the government to double down, because at least some of the information they're getting is being passed through a financially interested filter. Of course, it's entirely possible in this scenario that the emus will still eventually come out on top. But it's also hard to argue it's anything like a strategically optimal outcome. But hey, at least a couple of the people involved made a few dollary dues. And therein, just as with some of the other forms of corruption we've looked at, lies one of the main dangers here. Especially in some of these more dangerous forms, if you allow insider trading incentives to mount, you can have a massive disconnect between the amount that the insiders are able to make on a particular manoeuvre and the amount of damage they do in the process. Insiders might make millions betting on disruptions in the global energy market, for example, but those same disruptions might cost the global economy billions. These activities don't just transfer wealth, they can destroy it, as the emus in our scenario are likely to learn to their chagrin. Okay, so I think we can all accept that if you dial the hypothetical up to 11, it'd be possible for insider trading incentives to be pretty toxic for a military campaign. But I think it's also important to zoom back out and remember why most governments have made this kind of stuff illegal, namely that it can be pretty toxic economically and strategically as well. Markets arguably exist for a purpose, and they do those jobs better if they're fair. There are plenty of reasons you as an economy or a society might want a functioning share market, for example. They serve a capital raising and allocation function, and also enable people or funds to link in to industries they might not otherwise be able to access. Damo the Brickie, for example, might not exactly be well positioned to start his own satellite imaging firm, but if he wanted to, he could absolutely plough a couple of paychecks into the stock of one. The satellite nerds get their funding, and Damo's fortunes can now rise and fall with the space market. Across markets, a huge amount of capital belonging to ordinary people, retirement funds, or countries is invested in ways that might make it available to business, but also subject to the gains and losses of the economy. If you're a Norwegian citizen, for example, you probably have reason to care what happens to the country's $2 trillion sovereign wealth fund. Last year it made a return of about 15%, or $250 billion US, not bad for a country with a population just over 5 million. Just that one fund reportedly owns about 1.5% of the world's publicly listed stocks. Other people might be exposed through things like retirement accounts and funds. As of June 2025, for example, collectively Australians had about $3 trillion US worth of assets in their superannuation accounts. Like the American 401k, those are meant to be a key part of what makes it possible for people to actually, retire eventually. And so for the sake of many things, including social cohesion, countries probably have an interest in making it as safe as possible for people to put money into the market, realise the kind of gains historically associated with it, and rely on that rather than government pensions to make ends meet in their later years. Sufficiently rampant insider trading would potentially threaten that, because people might not want to participate in a game that they perceived is rigged against them. A recent analysis by the Wall Street Journal, for example, showed that the clear majority of accounts on prediction markets lose money, with most of the gains concentrating on a minority of accounts. And whatever the reason for that divide, whether it be better strategy, algorithmic trading, or insider information, it's arguably not a great advertisement for your average bloke on the street to put their money in the system and try their luck. From an economic perspective, if people don't engage in prediction markets, that's probably fine. But if capital starts embracing the strategic equivalent of hiding gold bars and cash under the mattress, rather than putting it out into the wider economy where it can be used and invested, at that point you can potentially have a problem. So even if you can't always guarantee the game is 100% fair, governments might have an incentive to make sure it appears fair enough that non-insiders are willing to put and keep their money in. But all of that really boils down to just a generic case of insider trading bad. Where things potentially get extra dangerous though, especially when war starts to be involved, is not so much when insiders trade based on what they know, but instead how they're incentivized to act based on what they know they can trade. We explain some of the ways this can potentially go wrong when we first talk about corruption. You give someone power over a decision, say a contract award for example, and you put them in a situation where they have two choices. They can do it the way they're meant to do, which is the best outcome for the country and society more broadly, or they can take a small kickback or personal gain to make the wrong decision for society, but the right decision for their property portfolio. An important point to make here about the incentive risk isn't just that it potentially encourages insiders to make particular decisions in order to move markets, it's how it potentially encourages them to move them. Because look, if the only way for insider traders to maximise their gain was to cause stratospheric, sustainable global economic growth and world peace, sure, the markets might not be fair, but I imagine your average punter on the street might be willing to take that on the chin. The problem is, a lot of the time, some of the biggest incentives might not be towards maximising stability, but volatility. Generally speaking, if you want an economy where there's lots of long-term investment and growth happening, along with everything else, investors might be looking for features like stability, predictability, and limited risk. If I'm thinking about sinking billions into a new aircraft factory, for example, which might take years to build and potentially decades to fully pay itself back, I'd want to be fairly confident that over that period, nothing changes to fundamentally blow up my business model. If the government might seize my business halfway through and chuck me out a window, that's obviously a problem. And if there's a chance that aviation fuel spikes in a way that suppresses demand for my aircraft, that's also a problem. So all else being equal, the more confident I can be in the stability of the situation, the more attractive investment becomes. But while a conventional business might value that stability, some of the greatest opportunities for insiders might pop up when things get unexpectedly unstable. Many of those tools we talked about, like options and prediction markets, are going to pay considerably more when a bet is placed on something unexpected and the unexpected ends up happening. If you look at something like the Soccer World Cup, the market's not exactly going to give you a cookie if you tip the likes of France or Spain to win. But say you're backing a legendary soccer superpower like New Zealand, and it might be a different story. The same thing applies with these kind of trades. Some of the biggest returns are going to be on the table when you're talking about violent, unexpected swings. If a trader has a bunch of call options on a share that unexpectedly goes from $10 to $50 overnight, they're going to make a crap ton of money. If they then exercise those options, grab a bunch of puts, and then the stock crashes back to $10, once again unexpectedly, it's a crap ton of money times two. The kicker, of course, being that for a well-informed insider, those unexpected swings might be entirely expected. And that starts to touch on a second point of problematic incentives, one that gets especially relevant when you start talking about people who have power to make decisions, not just information about them. If you assume, for example, that every time there is an unexpected swing in a market that an insider can accurately predict, there's an opportunity for them to make immense amounts of money, then you could argue that from the insider's perspective, the ideal kind of swinging event would be something that was artificial and easily reversible. It being artificial might mean you have more control over when the swing happens, and it being reversible might give you an opportunity to make even more money, yo-yoing the market back, doubling the opportunities for profit, while also limiting the long-term disruption to whatever market you're talking about. If you think about the kind of events that might fit that bill, a lot of them are going to be negative, because it's often going to be much easier to break or disrupt an economic system than it is to make it significantly better. And then to generate the swing back to the baseline, all you need to do is stop doing the original damaging thing. Tariffs are probably a good example here. They take very little time and effort to announce, can generate significant swings in the market when they are announced, and then are just as quick to pause or remove. As you can see on the right there, the original announcement of US tariffs back in April 2025 caused a weekly fall in the UK stock market of about 7%. That put it in roughly the same impact category as the week to the 21st of September 2001. But it's not just trade policy that comes into the spotlight here, it's potential military action as well. As we've seen clearly in recent years, it's very easy for war, or even just apprehensions about war, to impact global trade flows, commodity prices, and entire economies. And because even leaving aside specific prediction markets on individual military acts for a moment, markets in general can be so responsive to these kind of risks, there might be an incentive on people in the centres of power or surrounding those in the centre of power to raise and lower tensions of a military clash, or dial up and pull back the tempo of ongoing military operations, not just based on cold national strategic logic, but also the thought in the back of one's head of just how big the windfall from another expected market swing might be. Dig in even deeper to the nitty-gritty of military operations, and unless you're very actively policing insider risk, the opportunity for perverse incentives worm into the system at every level. If, early in the war, you knew the Russian Federation was about to launch large-scale attacks on Ukraine's grain export infrastructure, for example, that would be potentially tradable information. And by extension, for people in the Russian system who had access to or could influence that target list, there'd potentially be an incentive to create tradable information. Because even if it might not necessarily make great military sense to slam multi-million-dollar PGMs into grain silos, provided you could let your mate Yuri know before it happens, there might be an opportunity to show some entrepreneurial attitude and significantly augment your paycheck for the year. At a very high strategic level, the national interest might be in stability, but the personal interest in volatility. At the individual frontline level, the national interest in you keeping secret information secret, but the personal interest being in letting a couple of people know. So, if that's at least some of the risk involved here, let's turn to a more difficult question. What do you possibly do about it? One thing to say up front is that just as with some of the corruption we've talked about in the past, this is probably not a problem you can kill overnight. Personal profit motives are an incentive as old as time, and as long as there have been markets, there have been insider traders and manipulators. The elite of ancient Rome, for example, had their fair share of financial and economic schemes. Some had reason to see military campaigns as a kind of financial investment, and we have historical sources that attest to all kinds of rules and regulations. One Roman law, for example, reportedly restricted senators and their sons from owning sufficiently large merchant ships, with some historians suggesting that might have been tied to an intention to prevent senators from war profiteering and competing for military transportation contracts. Whatever the truth of the situation, the core point here is the incentives here are pretty fundamental, and trying to prevent those with power or information misusing it, basically a history-spanning effort. But the flip side here is you don't really need to entirely kill these practices in order to mitigate them. In some cases, just making something difficult or risky might itself be enough. You might not need to guarantee that a potential criminal is going to be caught and punished for doing this kind of thing. Instead, it might be enough to just make it a dangerous enough prospect that they're deterred from trying in the first place. Basically, you want to take the potential reward of insider trading and match it as best you can against an equal or greater risk. But if we want to cover specific potential measures, let's break the question up. First, what do you potentially do about the monumental risk of prediction markets? One possible answer, if you're not willing to ban the things outright, would be pressure and regulation, coming at this from two directions. First, you remove the ability to set up prediction markets in particularly sensitive or dangerous topics, say military operations, for example, where you really, really don't want to incentivize the insiders to present themselves on the market. And secondly, you try and keep the people likely to be insiders off the market. As I said earlier in this piece, for example, the US Senate only recently explicitly banned senators and their staff from trading on prediction markets. I don't know about you, but some might suggest that was a bit of a no-shit Sherlock maneuver. And it's probably best if the people responsible for making sensitive political decisions with access to lots of sensitive information not have access to the kind of platforms where that kind of information might give you a massive advantage. Another approach is less to do with government regulation and more how ordinary people engage with these things. Remember, unlike things like commodity markets that basically have to exist to enable the global economy to operate, there's no fundamental reason any prediction market has to exist, nor that money needs to be pumped into it. It's not critical to any economic function, for example, that people be able to put down money and predict what words Donald Trump might use in the next week. And yet, as you can see on the right there, that specific market for that specific week brought in a volume of about $2.7 million US. In these kind of prediction markets, the insiders can never walk away with more than the money that's been put in. If the insiders on a given question are buying yes, and they know the answer is going to be yes, their gains are coming from the people buying no. And so one suggestion might be that if the insiders or advanced traders are running the game, everyone else should consider just not playing in the first place. If there's no non-insider money to chase, then all else being equal, there's less incentive for the insiders to chase it. Now, if you pivot back to those big global markets, that's obviously not an option. You need things like global commodity markets, and if anyone who wasn't an insider couldn't put money into the stock market, implosion is probably too subtle a word for what would happen to the global economy as currently configured. And so here, the problem is much more fundamental and hard to attack. That said, some of the same tools we've talked about for fighting corruption apply. Maybe you set up accountability and traceability mechanisms so you know who owns what, who's making what bets, who's gaining and who's losing. If Sergeant Bosevsky's brother is suddenly cash buying a brand new Bentley, maybe someone should look into that. Or if senior leaders' family members are showing stock performances that verge on the clairvoyant, maybe it's worth having just a bit of a look into how they're making their selections. You might restrict the ability of insiders and their friends and family from engaging in certain trading activities and very publicly disclosing those that they do. And then, importantly, once you've established the rule set, you have to actually enforce it. That means actually funding investigation and enforcement activities and encouraging those organisations to go after people even if, or especially if, they're powerful or protected. As we suggested earlier, the goal here isn't to get everyone, it's to introduce risk. One advantage of some of these very capitalised public markets is that large trading spikes are hard to hide. Unlike some other forms of corruption that could take place entirely in the shadows, to be effective, a lot of these trades have to happen in the open. All else being equal, that might make it comparatively easy to spot very fortuitous trading activity. The key question is whether the system is able to move from seeing something suspicious to investigating it and preferably deterring it. The question now might be how, or if, nations decide to do so. And okay, channel update to close out. This episode's actually been a long time coming, but I thought now was finally the time to produce it and release it. It's been a long time since we had an entry in the Destroy's Armies series, and given some of the recent stories and events, I thought it was time for the first one of 2026. In any case, I hope you found the episode interesting, and we're back to something more traditional next week. Patrons, there should be a new post up for you within 24 hours roughly of this one going live, so please check that one out. And for those of you over at Brewing Gaming, you should be getting a full release schedule this coming week as well. With all that said, let me just say thank you once again, as always, for your ongoing support and engagement. With any luck, I'll hopefully see you all again next week.